There is a reference in the standard where when they give their base of conclusion, one guy said $5,000 as an amount, but the Chinese guy said he disagreed with the amount. So Chinese have to disagree, right? That's their job. I think his perspective was in different markets, 5,000 might be too big. So you're correct. It is not entity specific for low value items.
But from a practical impediment perspective, if I have like 2,000 leases, and as the way the calculations are run, I have to come up with 2,000 repayment schedule.
Correct.
Making sure that everything ends up to be zero at the end of the contract. So I just wanted to make up a call in terms of our own policy, organization-specific policy, which would be in line with overall IFRS framework.
Correct.
That cost versus benefit analysis.
Materiality.
Yeah.
But if it's not material, if any asset is not material, you don't have to capitalize it, period.
Exactly.
That's the general framework.
Exactly.
But the thing about low value items is they're material together. That's the difference.
Okay.
So the IFRS 16 exemption is specific. It says it is material together. So the exemption here is saying apply materiality throughout materiality. There's a reference to $5,000, which is it's a basis of conclusion, which is not the same as the standard. But the idea is if it's small, laptops and stuff like that, forget about it.
Yep.
So in your model in the bank, if you believe all these other leases are too small,
Yep.
and they're immaterial from the bank's perspective, that is just a general materiality concept.
Right.
Nothing to do with IFRS 16.
Exactly.
So don't mix the two.
Yeah, yeah. I wanted a similar base in order for me to frame that.
Yeah, it's general concept of materiality. I mean, some people have thresholds that are higher than $5,000. Same concept. All right. So I want to just a couple more things on this, and I want to get on to revenue. So just because you have a lease doesn't mean you're going to book it, right? Why? It depends how it's paid. So if you have a lease, there are two types of payments. There's fixed payments and variable payments, right? Now, there's two types of variable payments. There's payments that vary because of inflation or because it's linked to something. Your rent is linked to the price of oil. Your rent is linked to the price of gold. So those type of lease payments affect the asset and liability. The second type of lease payment is a variable lease payment that has nothing to do with the fixed amount that is based on usage. So if it's based on usage, we do not put that into the right of use asset, nor does it affect the liability. So one of the questions during the break was, someone works at a hospital, and what happens is they're given equipment by the drug companies. And the only string attached is they have to use the consumables supplied by the drug company. So let's say I'm doing blood tests. Here's a piece of equipment. It's expensive, but you can have it to use for free, on the condition that you buy the consumables that does the blood test only from me. So, do we have a lease? Yes. We have an identified asset. We decide the output, who we're going to test, when we're going to test, right? So do we have a lease? Yes. It comes now to the amount. What amount do we use? Because once you determine there's a lease, you've got to book an asset and a liability, right? Is there a fixed payment? No. Is there a variable payment under the scope of IFRS 16? No. So what do you book? Zero. So the payment is outside the scope of IFRS 16. So therefore, you book an asset of zero, a liability of zero. There's nothing to book. And when you use the consumables, that would obviously go to OPEX, not to CAPEX. So if you have a throughput where you're simply paying rent based on the oil, on the amount of gasoline or oil that's stored, again, the lease payment is based on usage. If it's based on usage, it's outside the scope of the standard, that particular payment. There might be some disclosure items. I don't remember those because I don't usually teach disclosure. I just get out the checklist. It's kind of a pain in the neck. But as far as the impact financially, there is no IFRS 16 impact. Does that make sense? So the question is, what do you do about the lease liability? So you reassess the liability if the lease term, the purchase option, or the residual value guarantee changes. You adjust the asset. The variable lease payment. Now, if the variable lease payment doesn't relate to an index or a rate, it goes straight to P&L. In other words, CAR4, rent, 5% of sales, outside the scope. Usage, you rent a car, you paste on mileage, outside the scope. That's just outside the scope. Now, if it relates to an index, so an index is like CPI, RPI, inflation index. So the question I had in Saudi Arabia, which threw me a little bit, and the standard refers to an index that's like a recognized index. In Saudi Arabia, what happens is the rent goes up every year, and it's decreed by their ruler. Just whatever they want. So the rent this year goes up 5%. So again, when I have those types of questions, what I said, well, in the West, we don't have those kind of rulers that make decrees. We have a different system. But I would say if it's decreed by the government in some sort of autocratic fashion, to me it's kind of like an index. It's MBS's index. So I would treat it kind of the same way. Although the standard specifically says it's supposed to be an external index. But I kind of view that somewhat similar. The rate of gold, the rate of oil. So if it's one of those, it doesn't affect the asset and liability. Otherwise it does. And when the rates change, you recalculate the asset, you recalculate the liability. Which means when you do your leasing implementation, it's a pain in the neck because every year when the rent changes, the asset changes, the liability changes, right? Which means you have to get your software re-engineered. Because in the old ways, we didn't do this, correct? In the old days, we booked the lease once and we didn't recalculate everything always. So it's a major pain. But I don't think it's hard from an accountant's point of view. It's a system point of view. You get your IT people and you fix it. And that's it.
I have a question.
Go for it.
After that decree where the rent...
In Saudi Arabia?
Yeah. So do we recompute everything including the revised interest rates in the market? Or we keep them constant to the time when we actually sign up that lease and just change the rent amount?
So if you use the fixed interest rate, you just rechange the variable lease. If the rent doesn't go up because of a variable interest rate, you simply recalculate the new lease payments with the original interest rate.
Okay, so other things keeping constant?
Correct. Correct. So you keep the effective interest rate constant unless the lease payments go up because they're linked to the variable rate. So you keep it constant. So is the hospital question clear now? Consumables. So a lot of times you might have a lease, but if there is no lease payments, who cares? Right? Because if all your lease payments are usage-based, it's irrelevant. It's irrelevant. So CARFOR, what they were saying is because they were very concerned about their ratios, as they entered into new leases, they wanted the leases to be a percentage of sales. Because for them, it's off balance sheet. Which makes sense from the standards point of view because if you sell nothing, you pay nothing. So there's really no liability there. The idea of the standard is if you sell nothing, you have to pay, book the liability. If you sell nothing and you don't have to pay, there is no liability. That's the gist of the standard. Does this slide make sense? So we spoke about this already. We use the original effective interest rate unless the lease payments change because of interest rates, the floating rate. Or if the lease term changes, we use the revised rate. So again, more prescriptive. I don't know how common it is here, but just like in IAS 16, the assets can be revalued. The same concepts apply. There's no difference. Same concepts. So no difference. Sell and lease back. So from the landlord's point of view, the question is it under the scope of IFRS 15 or not? So IFRS 15 is saying it's from the ordinary course of business, right? And if it's under the scope of IFRS 15 as a performance obligation, you basically sold the asset. You go from an asset to basically financial asset. And if you didn't sell the asset, you have the asset on your books, and you simply are going to have the rental income, and you depreciate the asset. So all that we're saying here, nothing's really changed. Lessor accounting is pretty much the same. Some of the terms have changed, etc., but it's basically the same. So if you actually sold the item, you have a financial receivable. If you didn't, and you also have a residual for the right-of-use asset you're going to get back. Because you might have sold 80% of the asset, but you get part of it back. You've sold it for a certain number of years. Generally, property is not going to be under the scope of IFRS 15, a lease for 5 years or 10 years, etc. It'll be out of scope. So pretty much the same. So lessor accounting, no really big changes. Some more disclosures, but basically the same. So US GAAP, just a couple of minutes on that. We still have a finance lease and an operating lease. We still have the criteria. That's unchanged. So US GAAP, this part hasn't changed. US GAAP, what's changed is if it is an asset where you consume more than an amount that's insignificant, effectively like a piece of equipment, that's going to be treated like a finance lease. And if it's a lease where obviously it's like a piece of real estate, you have it for a portion of the asset's life, effectively you don't consume more than an amount that's insignificant, then it's going to be like a finance lease. Why do we have these differences? It affects the treatment of that. So in IFRS, everything is effectively a finance lease. So remember, we don't use the word finance lease in IFRS. It's gone. It's only in America we use the word finance lease. So the difference is, if it's a finance lease, it affects basically how you book it. So in the balance sheet, you have a right-of-use asset that's the same if it's an operating lease. What's different is an operating lease, it goes in OPEX. A finance lease goes after EBITDA. It's part of CAPEX. And the cash flow is different. So that's what the U.S. has done. So the U.S. have basically said, we're not going to change the cash flow and the income statement. And the way we calculate the liability in the balance sheet is a little bit different. Because we don't use straight line depreciation in U.S. GAAP. In U.S. GAAP, it's a balancing figure, so the liability equals the asset for the operating lease. Because what you want is the expense needs to be constant straight line. So interest is not straight line. So as interest goes down, depreciation goes up. That's the American approach. So if you have any U.S. GAAP clients, you have to do any reconciliations, there's a difference here. One of the questions that I was asked is, could I have a depreciation policy where depreciation went up instead of down? And it's a good question. Because if you look at IAS 16, it doesn't really talk about that, right? I don't know. It's a form of accelerated depreciation. I've never seen it done in an IFRS context. So if you want to try that, you could be an adventure. I'm not sure what the auditors would say. The Big Four usually are very stickly on these things, right? They probably wouldn't like it. But I suppose you could call that your depreciation policy. But I'm not sure if they would accept it. Any questions up to there? So this is the year of transition, right? So you have a couple of choices on how to do this. You could do the grandfather scenario. So where if the previous assessment, so remember, how we assess if it's a lease or not is different than IAS 17, right? In IFRS 16, there's a more expanded definition. There's the 3 aspects, right? Which we didn't have in IAS 17. So in IAS 17, it was just simply an identified asset. That was it. There was IFRIC 4. That was it. So in IFRS 16, the requirements are a little bit different, right? The issue about control, about identified assets, it's a little bit different. So there's a grandfather clause, and if it was previously applied as a lease under IAS 17, you treat it as a lease under IAS 16. Otherwise, you don't have to. But for all new contracts, you do. I had trouble finding an example where it was not a lease under IAS 17, but it was a lease under IFRS 16. I couldn't really find many examples because the IFRIC was basically an identified asset. It was a much more simple definition. So I would expect it the other way around. I'd expect more leases would have been leases under the old standard than the new standard. But I think under the old standard, most of them were operating leases we didn't care about. Go back to my example with the power company, right? Was there a lease there under the old standard? Maybe. Do we care? No. Because it's an operating lease, what do we do? Nothing. So I found this one a little bit confusing. So the companies that I've worked with, they've all reassessed it for the IFRS 16 is how I've seen it done. Because the biggest issue in the IFRS 16 implementation is to go through all of your service contracts and say, is there any identified asset there that is material? So the big work we did, we did it at SABIC. It was a big pain in the neck. Went through all the contracts. They did some silly things like talking about would the uniforms being a lease. They went a bit over top. But they did scaffolding, everything. That was the big work about IFRS 16, is just to go through and to do your documentation. The transition guidance is you could do it retrospectively, which means go back and restate it, or you could do it prospectively.